In this video, we'll reveal 3 stocks that look beaten down today but could deliver a once-in-a-decade explosive returns over the next few years. These are not speculative startups chasing the next trend. They are established businesses with loyal customers, durable competitive advantages, and long runways for growth. Even more interesting, all 3 have seen their share prices collapse from previous highs, creating what some investors believe could be a once-in-a-decade buying opportunity. Let's jump into the first stock. The first company on our list is Chewy, ticker symbol CHWY. At first glance, Chewy might not look like an explosive investment opportunity. After all, this is a stock that has frustrated investors for years. Since becoming a public company in 2019, the stock has experienced dramatic swings, periods of investor pessimism, and concerns about slowing growth. Today, the stock remains roughly 14% below its IPO price and an incredible 58% below its 52-week high. For many investors, a chart like that immediately raises a red flag. They see a stock that has fallen more than half from its peak and assume something must be fundamentally broken. But what if the market is looking at Chewy completely wrong? Because when you stop focusing on the stock price and start examining the actual business, a very different picture begins to emerge. Chewy has quietly transformed itself into one of the most dominant businesses in the pet industry. Think about the economics of pet ownership for a moment. People may cut back on vacations, they may delay buying a new car, they may postpone upgrading electronics, but most pet owners are not going to stop feeding their dogs and cats. In many households, pets are treated like family members. That creates an incredibly resilient spending category that tends to hold up even when economic conditions become challenging. This is one of the reasons why the pet industry has become such an attractive long-term market, and within that market, Chewy has built something extremely valuable. The company is not simply an online retailer selling pet food. It has created a customer ecosystem designed around convenience, recurring purchases, and long-term customer relationships. The best example of this is its AutoShip program. AutoShip allows customers to schedule recurring deliveries of essential products like pet food, litter, treats, medications, and other necessities. The result is predictable revenue and strong customer retention. In fact, AutoShip now accounts for approximately 84% of Chewy's total sales. That number is incredibly important. When more than 4/5 of your revenue comes from recurring purchases, it creates a business model that becomes far more predictable than a traditional retailer. Customers do not need to remember to place an order every month. The products simply arrive at their doorstep. That convenience creates habits, and habits create loyalty. This recurring revenue engine has become the foundation of Chewy's success. Over the last 7 years, the company has nearly quadrupled its sales. That is an extraordinary achievement for a business operating in a relatively mature industry. Even more impressive, Chewy has successfully transitioned from a company focused primarily on growth to one that is now generating profits and strong free cash flow. That shift matters because many investors still think of Chewy as a company that is perpetually investing for growth with little regard for profitability. The reality is very different today. Margins are improving, cash generation is strengthening, and management is expanding into higher margin business segments that could significantly increase profitability over time. This is where the story gets really interesting. Most investors still view Chewy as an online pet supply company. Management increasingly views it as a pet healthcare and services platform. One of the biggest growth drivers could be Chewy vet clinics. Veterinary care is a massive and growing industry. Pet owners are spending more on healthcare for their animals than ever before. Routine checkups, preventive care, diagnostics, and treatments have become increasingly important parts of pet ownership. Recognizing this opportunity, Chewy has been aggressively building its veterinary clinic business. Following its acquisition of Modern Animal, the company expects to have approximately 60 Chewy vet clinics open during 2026. That expansion could become a game changer. Here's why. About 40% of new clinic customers were not previously part of the Chewy ecosystem. Think about what that means. The clinics are not simply generating healthcare revenue. They are acting as customer acquisition engines. They are bringing entirely new customers into the Chewy platform, and these customers are proving to be highly valuable. New clinic customers spend approximately $900 during their first year with Chewy. Compare that to the company's existing customer base, which averages about $600 annually. In other words, veterinary customers are spending substantially more than the average Chewy customer. That creates a powerful flywheel effect. A customer visits a clinic, they become familiar with the Chewy brand. They purchase medications, they order food, they subscribe to AutoShip, they become recurring customers, and over time, their lifetime value increases dramatically. This is exactly the type of ecosystem expansion investors should be paying attention to, but the opportunity does not stop there. Chewy is also investing in private label products, advertising, health and wellness services, and international expansion through Canada. Each of these initiatives offers higher margin opportunities compared to simply selling pet food online. As these newer business segments become larger portions of revenue, they have the potential to meaningfully improve profitability. That is important because valuation often follows profitability. When investors begin seeing a company generate stronger margins and more consistent earnings growth, the market typically becomes willing to pay a higher multiple for the business. Right now, that has not happened, and that is precisely why some investors are becoming interested. Chewy currently trades near an all-time low price-to-sales ratio of roughly 0.6. For context, investors are paying only about 60 cents for every dollar of annual revenue the company generates. At the same time, the stock trades at an adjusted forward price-to-earnings ratio of approximately 12.5. For a company with high single-digit revenue growth, improving margins, recurring revenue streams, and significant expansion opportunities, that valuation appears remarkably low. The market seems to be pricing Chewy as though its growth story has ended, yet the business itself continues to evolve and strengthen. The recurring revenue engine remains intact, the customer base remains loyal, the healthcare opportunity is growing, profitability is improving, and new customer acquisition channels are expanding. When you put all those pieces together, it becomes easier to understand why some investors believe Chewy could be one of the most misunderstood stocks in the market today. The stock may still carry volatility, the path higher may not happen overnight, but if management continues executing and successfully scales its higher margin businesses, today's valuation could eventually look like a bargain in hindsight. Sometimes the biggest opportunities emerge when investors focus too much on a falling stock chart and not enough on a growing business. Chewy might be one of those opportunities. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Our second stock is Sprouts Farmers Market, ticker symbol SFM. When most investors think about grocery stores, they usually picture a slow growth industry. Margins are often thin. Competition is intense, and many grocery chains spend years fighting simply to maintain market share. That is exactly why Sprouts Farmers Market deserves a closer look. Because this is not your typical grocery business, Sprouts occupies a unique position in the retail landscape. The company sits at the intersection of two powerful long-term trends that continue to reshape consumer spending habits across America. The first trend is the growing focus on health and wellness. The second is consumers' increasing willingness to spend more on products they believe improve their quality of life. Over the last decade, millions of consumers have become more conscious about what they eat. People are reading ingredient labels more carefully. They are paying closer attention to nutritional value. They are looking for fresh produce, organic products, healthier snacks, and functional foods that support long-term wellness. This shift has created enormous opportunities for companies positioned to serve those consumers. And few retailers are better positioned than Sprouts. The company has built its entire business around health-focused grocery shopping. Its stores are designed to emphasize fresh produce, natural foods, specialty health products, and differentiated offerings that appeal to wellness-minded consumers. That specialization gives Sprouts an advantage that many larger retailers struggle to replicate. Instead of trying to be everything for everyone, Sprouts focuses on serving a specific customer base extremely well, and that focus is producing impressive results. Despite operating in a challenging consumer environment where many households remain cautious with spending, Sprouts continues to demonstrate resilience. In its latest quarter, sales increased by approximately 4%. While that may not sound spectacular at first glance, context matters. Many retailers have struggled to generate meaningful growth under current economic conditions. The fact that Sprouts continues growing revenue while maintaining customer engagement speaks to the strength of its business model. Same-store sales declined about 2%. Normally, investors do not like to see negative same-store sales. However, considering the broader economic backdrop and the fact that Sprouts often sells premium products compared to traditional grocery chains, the decline appears relatively manageable. What is especially important is that the market may have already overreacted to these concerns. The stock has fallen roughly 50% below its 52-week high. That is a dramatic decline. But unlike many companies that suffer major stock price drops because their businesses are deteriorating, Sprouts appears to be facing more of a valuation reset than a business crisis. At one point, investor enthusiasm pushed the stock's valuation to levels that became difficult to justify. Now the pendulum may have swung too far in the opposite direction. Today, Sprouts trades at approximately 15.6 times forward earnings. For a company with meaningful growth opportunities ahead, that valuation begins to look very attractive. And this is where the long-term story becomes particularly compelling. Several years ago, management made an important strategic decision. Rather than continuing to build larger stores, Sprouts shifted toward a smaller store format. That move may not have generated headlines at the time, but it significantly improved the company's economics. Smaller stores are often less expensive to build. They require less capital investment, operating costs can be lower, and management can enter new markets more efficiently. The result has been improved new store economics and a stronger foundation for expansion. That expansion opportunity remains enormous. Currently, Sprouts operates approximately 483 stores across 25 states. At first glance, that might sound substantial, but management believes the company can eventually triple its store count over the long run. Think about that for a moment. Tripling the number of stores would dramatically increase the company's footprint across the country. It would introduce the brand to millions of new customers, and it would create opportunities for substantial revenue growth over many years. Importantly, that goal does not appear unrealistic. The demand for healthier food options continues to grow. Younger generations often place a greater emphasis on nutrition and wellness than previous generations. At the same time, the increasing use of GLP-1 medications is creating greater awareness around healthy eating habits. As more consumers focus on nutrition and weight management, demand for fresh, healthy food options could continue rising. That trend directly supports Sprouts' business model. But store expansion is only one part of the story. Management is also working on initiatives designed to strengthen customer loyalty and improve profitability. One of the most promising opportunities is the company's loyalty program. Strong loyalty programs can be incredibly powerful. They provide valuable customer data, they encourage repeat purchases, and they help create stronger relationships between retailers and shoppers. Over time, a successful loyalty program can become a meaningful competitive advantage. Sprouts is also expanding its private label offerings. This may sound like a small detail, but it can have a significant impact on financial performance. Private label products typically generate higher profit margins than third-party brands. When customers trust a retailer's own products, the retailer gains greater pricing flexibility and stronger profitability. Many of the most successful retailers in the world have used private label products to strengthen their competitive positions. Sprouts appears to be moving in that direction as well. When you combine all of these factors, a compelling picture begins to emerge. You have a company operating in a growing segment of the grocery market. You have a management team focused on disciplined expansion. You have improving store economics. You have new growth opportunities through loyalty programs and private label products. And you have a stock trading at a valuation that appears far more reasonable than it was just a few years ago. That combination is what often creates attractive investment opportunities. The market tends to focus heavily on short-term challenges. Investors become concerned about quarterly results. They worry about temporary consumer weakness. They react to small fluctuations in same-store sales. Meanwhile, long-term investors are asking a different question. Where will this company be 5 or 10 years from now? If management successfully executes its expansion strategy, grows store count substantially, increases customer loyalty, and continues benefiting from long-term health and wellness trends, today's valuation may ultimately prove far too conservative. What makes Sprouts particularly interesting is that it offers both growth and a clear runway for expansion. Many companies eventually run out of places to grow. Sprouts still appears to be in the early stages of a much larger opportunity. The company is not trying to reinvent itself. It is not relying on speculative technologies. It is not chasing temporary trends. Instead, it is building around a fundamental shift in consumer behavior that could continue for decades. People want healthier food. People want greater transparency about what they eat. And people increasingly view nutrition as an investment in their future well-being. As long as those trends continue, Sprouts has a powerful tailwind supporting its business. And with the stock trading about 50% below its 52-week high, investors today have an opportunity to evaluate the company from a very different starting point than they did when optimism was at its peak. For long-term investors willing to look beyond short-term market sentiment, Sprouts Farmers Market may be one of the most intriguing growth opportunities hiding in plain sight. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Our third and final stock is Tractor Supply Company, ticker symbol TSCO. At first glance, Tractor Supply might seem like one of the least exciting businesses on the stock market. It sells livestock feed, pet food, farm supplies, tools, workwear, fencing materials, and products geared toward rural lifestyles. That description alone is enough to cause many investors to scroll right past the stock without giving it a second thought. And that may be exactly why the opportunity exists, because beneath the surface is a company that has quietly built one of the strongest customer ecosystems in retail. More importantly, it has done so in a niche that many competitors simply cannot replicate. One of the most dangerous mistakes investors make is assuming a business is unimportant because it is not constantly making headlines. The truth is that some of the best investments in history have come from companies selling products people need every day, not products people want occasionally. Products they genuinely need, and that is where Tractor Supply stands out. Its customer base depends on many of the products it sells. Farmers need livestock feed, pet owners need pet food, property owners need fencing supplies, rural homeowners need maintenance equipment. Many of these purchases are recurring necessities rather than discretionary purchases. That distinction matters enormously. Businesses built around recurring needs tend to be more resilient during economic downturns. Customers may postpone buying luxury goods. They may delay major purchases, but they are still going to feed their animals and maintain their properties. That creates a level of stability that many retailers simply do not have. Yet despite these strengths, the market has become increasingly pessimistic about Tractor Supply. Sales growth has slowed to approximately 4%. As a result, investors have punished the stock. The shares have fallen roughly 51% from their 52-week high. A decline of that magnitude often suggests a business facing severe challenges. But when you examine the fundamentals, the reality looks much different. The market appears to be treating Tractor Supply as if its best days are behind it. The business itself suggests otherwise. Tractor Supply remains the dominant player in its niche. The company operates approximately 2,435 stores across the United States. That scale provides meaningful advantages. It strengthens supplier relationships. It improves purchasing power. It increases brand awareness. And it creates operational efficiencies that smaller competitors struggle to match. The company's leadership position is one of its greatest assets. When customers in rural communities need products for their homes, farms, livestock, or land, Tractor Supply is often the first place they think about. That kind of brand recognition takes decades to build, and once established, it becomes extremely difficult for competitors to disrupt. But the store network itself is only part of the story. The real secret weapon may be the company's loyalty ecosystem. Tractor Supply's Neighbors Club Rewards program has grown into a massive competitive advantage. Today, the program has more than 38 million members. That number alone is impressive. But what makes it truly remarkable is what those members represent. Approximately 80% of Tractor Supply's sales come from Neighbors Club members. Think about that for a moment. 4 out of every $5 generated by the company comes from customers who are actively participating in its ecosystem. That level of engagement is extraordinary. It demonstrates just how deeply embedded Tractor Supply has become in the lives of its customers. The loyalty program provides benefits for both customers and the company. Customers receive rewards and incentives. The company gains valuable insights into purchasing behavior. That information helps management improve inventory planning, personalize promotions, and strengthen customer relationships. The longer customers remain in the ecosystem, the more valuable those relationships become. And because many purchases involve recurring necessities, members have strong incentives to keep coming back. This creates a powerful moat. A moat is not always about technology. It is not always about patents. Sometimes the strongest moat is simply being deeply integrated into your customers' daily lives. That is exactly what Tractor Supply has accomplished. Now let's talk about growth. At first glance, some investors may assume Tractor Supply's expansion opportunities are limited. Management's long-term goal is to grow from approximately 2,435 stores to around 3,200 stores. That is certainly meaningful growth, but it is not as dramatic as some high-growth retail concepts. However, focusing only on store count misses a much larger trend. One of the most important demographic shifts in America has been the ongoing movement toward rural and semi-rural areas. Many families have been seeking more space, lower living costs, and different lifestyles outside major urban centers. This migration trend has created favorable conditions for businesses serving rural communities. As more people move into these areas, demand for the types of products Tractor Supply sells naturally increases. New homeowners need supplies, property owners need maintenance products, pet ownership often rises, and rural lifestyles create ongoing demand for essential goods. In many ways, Tractor Supply is positioned directly in the path of this demographic tailwind. That provides an additional growth driver that many investors may be underestimating. Another aspect of the investment thesis that deserves attention is the company's dividend. Income investors are often searching for businesses that can consistently grow their payouts over time. Tractor Supply stands out in this area. The company's dividend yield has climbed to approximately 3.1%, which represents the highest yield in its history. Whenever a high-quality company reaches its highest historical dividend yield, investors should pay attention. A rising yield often signals that the stock price has fallen faster than the business fundamentals. Even more encouraging, the dividend appears very well supported. The company uses only about 46% of its net income to fund dividend payments. That leaves a substantial margin of safety. Management has also increased the dividend for 16 consecutive years. That track record demonstrates a clear commitment to returning capital to shareholders, and because the payout ratio remains relatively conservative, future dividend growth opportunities remain intact. For long-term investors, that combination can be extremely powerful. You are not simply buying a stock, you are buying a growing stream of cash flows. Every dividend increase raises the income generated by your investment. Over long periods of time, those increases can contribute significantly to total returns. This is one reason why many of the greatest wealth-building stocks in history have been dividend growers, rather than simply high-yield stocks. Tractor Supply appears positioned to continue following that path. Now let's step back and look at the bigger picture. You have a dominant niche retailer. You have a massive and highly engaged loyalty program. You have recurring purchases that drive predictable revenue. You have demographic trends working in the company's favor. You have continued store expansion opportunities. And you have a dividend that has been growing for well over a decade. Yet despite all of these strengths, the stock is trading at roughly 15 times earnings and remains about 51% below its 52-week high. That disconnect is exactly what value investors look for. The market often becomes obsessed with short-term growth rates. When growth slows, investors sometimes assume the story is over. But mature businesses do not need explosive growth to create significant shareholder value. They need durable competitive advantages. They need loyal customers. They need strong cash flow generation. And they need management teams that allocate capital wisely. Tractor Supply checks all of those boxes. Will the stock double overnight? Probably not. That is not the point. The appeal here is something different. This is the type of company that can quietly compound wealth year after year. The type of company that rewards patience. The type of company that investors often wish they had purchased a decade earlier. When high-quality businesses trade at depressed valuations, long-term opportunities can emerge, and Tractor Supply appears to be one of those situations. So when we look across all three stocks discussed today, we find a common theme. Each company operates in an industry with long-term relevance. Each company has built meaningful competitive advantages. Each company maintains strong customer relationships, and each company is trading dramatically below previous highs. Chewy is building a powerful ecosystem around recurring pet care spending and expanding into higher-margin healthcare services. Sprouts Farmers Market is capitalizing on the growing demand for healthier eating while pursuing an ambitious expansion strategy. Tractor Supply is leveraging its dominant position in rural retail, massive loyalty program, and growing dividend to create long-term shareholder value. The market may be focused on today's uncertainty. Long-term investors are focused on where these businesses could be years from now. That difference in perspective is often where the biggest opportunities are found. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these three businesses do you believe has the strongest long-term competitive advantage? Chewy with its recurring auto-ship ecosystem, Sprouts Farmers Market with its health-focused growth strategy, or Tractor Supply with its massive loyalty program and rural retail dominance? Let me know in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.